Good morning, everyone. I'm Wes Burke with Central Coast Lending. Friday gave the mortgage market some relief. Monday is asking whether we get to keep it. And if you're looking at this through a secondary market lens, the story this morning isn't simply are rates up or down? The better question is, what is the MBS desk worried about next? Today, there are three answers: oil, Treasury supply, and Wednesday's CPI. At this morning's snapshot, the 10-year Treasury is around 4.69%, up roughly 4 basis points. UMBS 5.5 mortgage-backed securities are around 99.31, down roughly 7 ticks on the day. Mortgage News Daily is describing MBS as moderately weaker this morning. Some of Friday's bond market improvement is being handed back. And that matters because Friday's rally came after a genuinely weak employment report. The economy unexpectedly lost 23,000 jobs in July compared with expectations for a gain, and that caused traders to sharply reduce their expectations for a September Fed hike. But markets have short memories. Today they've already moved on. Mortgage News Daily finished Friday with its top-tier 30-year fixed index at 6.74%. Freddie Mac's latest weekly average is 6.69%, and MBA's latest weekly contract rate is 6.81%. Now here's the inside baseball number. Take that 6.74% MND rate and subtract this morning's 4.685% 10-year Treasury. You get roughly 206 basis points. That is not an MBS option-adjusted spread. It's simply a useful public proxy for how much distance remains between the consumer mortgage rate and the Treasury benchmark. And it's a good reminder that a 5 basis point Treasury rally does not automatically mean the borrower gets a 5 basis point improvement. Here is today's real secondary market story. We need to talk about convexity and extension risk. When mortgage rates rise, fewer homeowners refinance. When fewer homeowners refinance, MBS investors get their principal back more slowly. That means the expected life or duration of the mortgage portfolio gets longer, and investors then have to hedge that extra duration. Writers reported last week that mortgage-related hedging helped drive extraordinary activity in swap futures after the recent rise in rates. Translation for a loan officer: sometimes rates go up because the economic news is bad for bonds, and sometimes the mortgage market itself helps amplify the move. That's the kind of thing you don't see in the consumer headlines. Oil is also back on the desk this morning. Reuters' latest snapshot had WTI around $80.73 and Brent around $86.11, both up more than 3%, as markets reassess whether the Strait of Hormuz can reopen without further U.S.-Iran escalation. Why do mortgage people care about oil? Because oil feeds inflation expectations. Higher inflation expectations can push Treasury yields higher. Higher Treasury yields pressure MBS. And weaker MBS can eventually mean worse rate sheets. That chain is not perfectly one for one, but right now the bond market is absolutely watching it. There isn't a major economic report this morning, which means today is largely about positioning. But the quiet ends quickly. Tuesday brings a $58 billion 3-year Treasury auction. Wednesday is the big one. July CPI at 8:30 Eastern, followed by a $42 billion 10-year Treasury auction that afternoon. Thursday brings PPI and the $25 billion 30-year auction. And Friday brings retail sales. The current Reuters consensus has headline CPI expected around 3.4% year over year versus 3.5% previously. Meanwhile, markets are pricing roughly a 48% probability of a September Fed hike. We are basically sitting on a coin flip, and CPI can change that quickly. For loan officers, I'd make 3 moves today. First, don't sell Friday's improvement as a new rate trend. We have one encouraging labor report. We do not yet have confirmation from inflation. Second, pay attention to your floating pipeline. With MBS weaker this morning and CPI coming Wednesday, Borrowers with tight payment tolerances should have an actual lock strategy, not just a hope that rates improve. Third, use the rate movement to create conversations. MBA reported total applications down 2.9% in its latest survey, with purchase applications down 4% and refis down 2%. Consumers are highly rate sensitive right now. A small pricing improvement can matter. So can losing one. Here's today's bottom line. Friday was about jobs. Monday is about whether that rally can survive oil, treasury supply, and inflation risk. The 10-year is back near 4.69%. MBS are weaker. And Wednesday has the potential to reset the entire conversation. Don't predict the market. Understand what is moving it. Manage the float. And use the volatility to create better conversations with borrowers and referral partners. One more thing before I go. If you're a producing loan officer, we're building something you'll want to hear about. It's a structured, compliant office access platform that puts the right loan officers inside select real estate brokerages on a published schedule with the brokerage's blessing. You bring the relationships. Central Coast Lending brings the banking platform, the compliance structure, and a formal way to deepen what you already have. If you're tired of being told to go build realtor relationships from scratch and you want a program that formalizes what you already have with a local mortgage bank behind you, give me a call. Let's talk.